Welcome back. Today we're going to unpack what the tokenization of securities really means, why it's poised to reshape financial market infrastructure, and what investors, issuers, and intermediaries need to understand about the near-term implications. Don't forget that if you have another topic you'd like to learn more about, let us know in the comments. First, definitions. Tokenization is the process of issuing a financial asset as a blockchain token or representing an existing asset with a token, so ownership and transfers are recorded on a distributed ledger. Think equities, bonds, funds, real estate interests. The instrument stays a security. The record-keeping and transfer rails change. Independent analyses project that tokenized assets could reach into the tens of trillions of dollars by 2030, which hints at the scale of change underway. What does that change in practice? Markets today were built for a paper era, then digitized but not redesigned. You still see fragmentation by jurisdiction, duplicative ledgers, reconciliation steps, and settlement lags. In the US, we only recently moved from T+2 to T+1 settlement. That's faster, but it's not seconds. Tokenized assets can settle near instantly on-chain, with finality governed by the blockchain's consensus, reducing counterparty risk in the operational chore of post-trade reconciliation. How does tokenization enable that? With two building blocks, on-chain tokens and smart contracts. The token carries the ownership record. The smart contract is code that automates the life cycle: issuance, transfers, coupon or dividend logic, redemptions, and corporate actions, according to predefined rules. The programmability of these smart contracts is why the same asset can be issued directly to investors' wallets, transferred peer-to-peer, or embedded into more complex workflows, without manual intermediaries at each step. Accessibility is another shifting factor. Since tokens can be fractional, minimums can fall. And because blockchains run continuously, transfers can complete in minutes, not days, even outside traditional market hours. And because a wallet can be the holder of record, investors have the option, subject to local rules, to self-custody or to use qualified custodians. The result is broader participation, faster post-trade, and the potential to connect traditional assets with new forms of financial tooling. Now, a word on regulation and legal certainty, because none of this matters unless the law recognizes the asset. Several jurisdictions have moved first. Switzerland's DLT Act enables the issuance and trading of ledger-based securities with regulated DLT trading facilities. Germany's Electronic Securities Act, the EWPG, allows purely electronic, tokenized securities and crypto securities registers. In the European Union, MiCA establishes a harmonized framework for crypto assets not already covered by existing financial rules and is now rolling into force. These are examples of how legal regimes are adapting the rulebook to the new rails. So what changes for market participants? For issuers, tokenization can compress issuance timelines, automate corporate actions, and expand distribution, potentially issuing directly to investor wallets through regulated venues. That reduces friction and can cut intermediated costs in the life cycle of a bond or equity offering. For investors, tokens unlock fractional access, faster settlement, and optionality around custody. In some frameworks, moving the token to a self-controlled wallet allows you to pledge it as collateral or participate in new forms of financial services, always subject to securities, custody, and lending rules where you live. The infrastructure upgrade is speed and programmability. The obligations remain KYC, AML, suitability tax, and investor protections. For exchanges, banks, and CSDs, the business model shifts from reconciling many private databases to operating or integrating with shared ledgers, permissioned or public. Value migrates toward compliant token issuance, regulated trading venues, qualified custody, and data and risk services living atop the chain. Many incumbents are already building dedicated digital asset units because the rails are changing, even if mass adoption takes time. Let's stay realistic about limits and risks. Blockchains don't erase legal settlement, disclosures, or investor protections. They change how we execute them. Smart contracts can have bugs. Oracles that bring off-chain data on-chain can fail. Liquidity can fragment across chains and venues. and regulation is evolving, sometimes unevenly. While some regions provide clear routes to tokenized securities, others remain cautious or impose pauses pending clarity. A sound program addresses audits, key management, business continuity plans, chain selection, and cross-border compliance from day one. Pulling it together, here's a simple mental model. Same financial product, better rails. Tokenization keeps the asset's legal character, but moves issuance, ownership, and transfer to programmable, shared ledgers. Faster, simpler post-trade. Near-instant on-chain settlement reduces reconciliation and counterparty risk. Even as T+1 advances the legacy rails, programmable settlement pushes beyond. Wider access, smaller bytes. Fractionalization lowers minimums. Wallets expand custody choices. Distribution can be global, within local rules. Laws catching up. Jurisdictions like Switzerland and Germany have explicit tokenized security statutes. EU-wide rules under MiCA are coming online. Programs must align with those regimes. The bottom line, tokenization isn't about speculative coins. It's a modernization of market infrastructure that uses code to do what manual processes, batch files, and overnight nets have done for decades, only faster, with fewer intermediaries, and with new options for how investors and issuers interact. The technology has matured, legal frameworks are solidifying, and incumbents are adapting. The next phase is careful, compliant scaling, asset by asset, market by market. Thank you for watching. If you found this helpful, don't forget to like the video and subscribe so you never miss our latest content.